Good morning, and thanks for joining us here on Condo Solutions. Monday mornings, 9 to 10 o'clock, we talk about all things condo, HOAs, timeshares, and co-ops. All of those kind of interesting things that you may have a question about. We're here to help you with the answers. My name is Mark Breckbill. I'm a local CPA and a community association manager, along with Peter Mullengarden. Peter's our attorney. He's been doing this work in the Sierra industry, the condos and HOAs, for a gazillion years, now a gazillion plus years, and has been on the show with us here since the beginning, some 16 or 17 years ago, and has been here helping out, answering questions and providing advice to the community as a customer service community service program for years now. So we appreciate that. Give you the little ground rules that we always give every Monday morning. One, free to call in. It is a community support program, a community service program. 220-9788, 220-WSTU is the number in the studio. A couple things that we caution you about is one, we're going to give you the best answer we can, but we don't have your documents. So we'll give you an answer based on your interpretation of the documents and general practice, common rules, regulations, court cases, things like that. Second thing is that we need a name, but we don't need an association. And in fact, we prefer we don't have one, only because of a couple things. One, somebody out there may listen and say, hey, that's not my association, so it's not my problem. I'm going to switch the other channel here for a minute. And we don't want them to do that, because the problem, it might be the exact same problem as theirs or slightly different. And that's just slightly different. And that's why we will generally talk about a problem as it relates to, a broader perspective as well, just in case that somebody's issue is a little bit different than yours. But other than that, that's probably the main caveat, the main thing that we tell you about. Otherwise, we're going to try to give you the best help we can. And frankly, on the legal side, there's no one better than Peter in this kind of thing. And he does have a lot, 40 years without gaining some kind of knowledge on it and being an expert. And so he is. And now even the Florida bar recognizes his specialty. So we appreciate that. Other than that, good morning, Peter. How you doing?
Good, Mark. Good morning. How are you?
Good. We got our first caller right away here, so we're going to go to her. But I wanted to, again, just say, as we always do, that, I appreciate all the stuff that you provide for our listeners, all the information you give them, and I know they do too. So want to thank you for that. I try to do that once every 16 or 17 years or so don't get used to it. But anyway.
Don't worry, I'm not.
Yeah.
Thanks.
No problem. Okay, we got our first caller, Barbara. Go ahead.
Good morning, gentlemen.
Good morning.
I'm hoping that you're all dry.
Mm-hmm. That's hard to do. I came in by boat. That's why I was running a little late. I had to get in a little skiff that took me across the parking lot. It's pretty wet down here.
Yeah. Same here. All right. Mark, this is for you. This is a hypothetical question.
Oh, I love those.
Hypothetically speaking, you as a CPA, if you find out that something that you've been listing as a CD under the cash portion of the audit is actually an annuity, okay? What? And you bring it, and you were to find this out, and so you decide, well, I'll just list it with the investments, but I'll keep it with the cash reserves. Does this not raise a red flag? And what is your responsibility in this?
Oh, good question. Well, first of all, let me ask you, you're saying, is this with an audit, or are you saying just tax prep?
No. This is an audit.
Okay. So, because the answers are a little bit different, because in an audit, we have, in a tax situation, we have less responsibility for classification and classification errors. As long as we get the tax aspects of it right, the rest of the stuff doesn't make a difference. But your question is very, very significant as it relates to audit. And that is that in an audit situation, a couple things change. One, if that is a CD, as you pointed out, on the balance sheet, you would have potentially what you would have is you would have cash, and then you might have other investments, which would include the CD, and then you might have stocks, bonds, and other types of investments like that listed in the audit section. I mean, in the on the balance sheet. The thing that makes a difference here, Barbara, is relative to what you're required to do from an income statement standpoint and a disclosure standpoint. What I'm getting at is that, first of all, in our situation, we kind of take the position that if you've got a CD and in today's environment, there's really no penalty, no significant penalty or material penalty for canceling that CD. So we actually consider a CD like that cash. With an annuity, that's a different story. It has a life. It can't generally be cashed in without some significant loss. And so where it would be on the balance sheet, at least in our situation and in a lot of CPA situation, is that it would be much closer to cash, whereas an annuity would be much, much closer to a long-term bond or to some sort of a long-term investment. That's the first thing. And so it would distort the liquidity of the association. If somebody's, and that's an important thing when somebody's looking at the balance sheet on an association, is if they have to have cash to make a reserve repair or fix something in the reserves. It's one thing to have a recognition that you've set it aside in the reserves, but it's another thing to be able to get the cash without penalty to fix that item. And if that is a annuity rather than a CD, it significantly impacts the reader's view of the financial statements. I would be concerned if I'm looking at the financials and know that the association is going to incur a penalty of 10% or something like that if they had to tap those the annuity, or maybe they can't even tap it. Maybe they'd have to borrow money in the interim, and I'd have to incur some borrowing costs. So that's the first thing. The second thing is when you get into investments that are beyond CDs and you're into stocks, bonds, that kind of thing, the investment disclosures in your financial statement are completely different. There's a whole set of required disclosures. And also your income statement changes. You now have what's called comprehensive income. And that's a whole different income statement than the one that you normally would get. So your income statement should have been changed. And it would report the income differently. It would have an income from operations, and then it would show the adjustment to the stocks and bonds, depending upon how they're set up. They would either go through income or go through equity, and you would have you'd have a comprehensive income statement. So, and that's actually a separate presentation. It can be added on to your existing income statement, but it's actually a separate presentation. So your balance sheet changes, your liquidity and cash flow change, your disclosures change in your footnotes, and your income statement changes. So that's what would happen in that situation if somebody didn't realize that's what they had, that they had an annuity instead of a CD.
Okay, but the question remains, if that had happened to you, what
would we have done?
Yeah.
When we found out, we would pull back in the financials and change them. So is what we would have to do. We would have to pull them back in and change the financials, change the disclosures, change the presentation, change the income statement. We would have to make some significant changes. And the funny thing is that, truthfully, there's not a lot of CPAs out there, even ones that deal in the CIRA industry, that are used to doing a comprehensive income statement. It just doesn't come up that much. And so, it would be a major change to do, and it would. But at that point, you've got a set of financials out there that are wrong. And in the opinion that the CPA gives, they give an opinion on those financial statements, and one of those financial statements is going to be listed incorrectly because it doesn't say it's a comprehensive income statement, and it's not a comprehensive income statement. So, so what you've got is an incorrect set of financials. The financials are the associations. So, but as a CPA, once I find out that those financial statements were incorrect, and I make the decision that they're material, which in this situation I don't see how you could avoid making that decision because the presentation is wrong. Then it's the CPA's responsibility to correct their opinion or correct the financial statements and pull the financials back.
Okay, and the comprehensive income statement, would that be included with the audit?
Yes, mm-hmm. It is. It actually takes your basic income statement and then adds the investment transactions in there, kind of as kind of a non-operating type of income, and it actually would be presented on the financial statements as and then also there's a question of how you would record at what amount you record the annuity and how you record the annuity. It's under GAAP now. It's basically got to be stated. Technically, it would be stated at fair market value. So if that thing is increased or decreased, you'd have to record the increase or decrease, and run that through. Typically, run that through the income statement. So what's happening? Let's say you bought that annuity, and now that annuity is let's say it's a variable annuity. It's invested in stocks or bonds or something, or even if it's a fixed annuity and it's got an interest rate to it, you would have to revalue that annuity. In fact, you'd reprice it or look on the broker statement or whatever and find out what the value of that annuity is to liquidate after penalty. And then that number, whatever that increase or decrease is, would go through your income statement, and you'd have to record it on your income statement, your comprehensive income statement. So it's a complicated process. When I know if we were in a situation personally where we'd have that kind of situation, we'd also increase our fee because it takes a different person to do that kind of work, more experienced person to do that kind of work. It's a higher level of reporting that we would have to deal with, and so typically our price would go up on something like that too.
Okay, well, so hypothetically, if this was then shown under a level 3 investment, under the fair value measurement,
yes.
And it's added to the total investment account, but the cash portion your cash portion remains the same, then apparently, well, I can't say that, but
the cash position the cash shouldn't stay the same because the cash is in the annuity, and the annuity is now, as you pointed out, it's called a level 3, which means that there's no specific price for it. It has to be valued. It's called black box pricing, and black box. You'd have to reprice that, but that is down in a different section of the balance sheet. It's not up in cash, and it shouldn't be in cash. It's an annuity. It should be in an investment account, and that's on a different place in the balance sheet. And there's really no way around that. I mean, it has to be.
It's hypothetically, if it remained in the cash, two things. Number one, the auditor apparently never saw a copy of the CD that you would have been told it was. If you were told it was a CD, would you not want to see a copy of the CD? Actually,
that's kind of funny because what happens is that if it's a CD, typically you would record that as you would confirm it. So what we would do, and you don't have to, but what we would do as a firm, so I'll talk about what we do. We confirm cash. So if we're told something is in a bank CD, we're going to try to confirm that account with the bank. Now, whether they'll confirm it or not, that's a different story, but we're going to try to confirm it with the bank. We're not required to. We can get other evidence that, documents that it's a CD or whatever. For example, we could, if we had it in last year's audit and the maturity was longer than this year, so we knew it was going to still be there, and or it matured and we saw it go into the bank account, and then we saw it come out again and go into another bank as a CD, as a purchase, then,
Right.
we might not confirm it if we had documentation to that effect. Our firm we confirm. If we can get the confirmation, it's just the better way to go because we know exactly what we're dealing with. And at the same time, when we send stuff like that to the banks, we also ask them to provide if the association has borrowed any money. Now, we don't always get those answers nowadays. The big banks in particular aren't very cooperative, but we do always do that. And if we can't get that, then what our people are told to do is get with the association, ask the bookkeeper or the manager to log on to their online bank account and let us see what the balances are. Show us the balances at the bank account. If for some reason or another that they don't have online banking or whatever, we typically have them go down or have them go down with us to the bank that they bank with and ask one of the bank managers to bring up their accounts so we can at least visually see that the account exists and how much is in it. That's not, the same as a sign off. We don't know necessarily if that CD is pledged to something, but we do know it exists. So that's what we would do. But I tell you, most firms probably would let it go. If it was there before, especially if it was there last year and it's there again this year, I'm not sure that they would do much on that. But they should.
Okay.
Yeah.
Okay.
Good.
All right.
That's a good question. That's a good point. A lot of people don't realize what you get into on some of these other investments, and it's not straightforward, and it's not clear. And so anyway, I
have another question. May I ask, please?
Sure, go ahead.
Is it possible for hypothetically, is it possible for an annuity not to be listed in the official records of the condominium association?
No, not if it's owned by the association. It has to be listed. So if it's not listed as part of the association records, it would mean that it's not part of the association's assets. And so therefore you got a bigger problem. Somebody owns it other than the association. But yes, it should be a part of the records. And I did confirm. I mean, I didn't confirm, but I did get some additional information. I was on a conference call a couple weeks ago with the state CIRA committee, our state FICPA committee, and our legislative group was saying that this whole concept of investments in annuities came up during the last legislative session, and it was shot down. So, when I said to you before, can the association invest in annuities? The answer is no. It's not. At least as a condo association, it's not a legitimate investment. It's not an investment that's allowed. There has been efforts by the insurance industry to try to get that allowed, which is a big mistake. And, the CPAs are fighting it and everybody else is fighting it. And along with that same thing, they're asking for broader investment ability. And then at the same time, they're going to ask CPAs to sign off on the reserves as to whether or not they're adequate, which we can't do and will never do. So that's what's going on right now. There's some group that's trying to push through the insurance industry, is trying to push these annuities. And, the state has still fought back and pushed back. So as it stands right now, that's not a legitimate investment.
Okay. So just to make sure I understand what you said, basically the state or the division you were dealing with and the legislature have said that annuities are not allowed. Is that
right?
Number one.
Right. They fall outside of that. They fall outside of the criteria for investments, for allowable investments. And
number two, would it be accurate to say that the reason an annuity might not appear in the official records is because the annuitant cannot be the association? It has to be a person because you can't insure the life of a corporation. Would that be an accurate statement?
No, because the owner. So what would go in the official records is whoever owns the policy. So let's say the corporation owns the policy, and they're the beneficiary, but they have a person as an annuitant. All right. Well, that would go on their books because they actually own the annuity. and they're actually the beneficiary of the annuity. The fact that they have an individual as an annuitant does not indicate that, that it's not owned by the association. But if it was not owned by the association, if it's owned by the individual who's also the annuitant, even if the beneficiary is the association, then at that point it would not be on the official records because it's not owned by the individual. I mean, by the association, it's owned by the individual. But at that point, for it to be in the individual's name and owned by the individual, there would have had to been a fraudulent transfer of assets from the association to the individual. You can't just an association can't just give somebody money, no matter what they're going to do with it. You can't just give them the money and put it in their name. So, that would be, that basically would be theft. So, so that's where you're at. I mean, so if it was recorded, let's say it's illegal. I mean, it's a non-allowed investment. But let's say even if it was a non-allowed investment, if the association did it and the insurance is in the association's name as the owner, then that should be on the official records. It should be on the association's balance sheet, and it should be listed. All right. If it's not, it's either an oversight, which is a problem, and it should be listed right away, and the cash should be shown that it was used to pay for it and all that kind of stuff, or it should be it's a fraudulent activity and it should be reversed. And it's that doesn't necessarily mean that the board member goes to jail, but it is an activity that isn't allowed as a director, and that they're uninsured for that kind of activity most likely, and they have issues with it, from a fraud standpoint, because they've received a benefit by owning that policy. So there's where that's kind of where you're at, Barbara, is that there is really kind of no way that it shouldn't have been on the balance sheet and disclosed. If they're trying to say it's because the annuitant was an individual, well, that still doesn't make any difference. That just means that individual is basically involved in the transaction, but it doesn't mean they own the policy. If they do own the policy, like I say, then that's a problem. And so, and I can't imagine a legitimate broker wouldn't check this out. And if an association came in and tried to make an investment in an annuity, I would think that broker would check that out right away to find out if that's a legitimate investment. They'd have to have stuff signed off on by the corporation. So, if the board, in an effort to avoid that, because the broker said, no, I can't do it with the corporation, transferred that money to an individual, so the individual could do it, naming the association as the beneficiary, then that's a fraudulent act. I mean, that's an illegal activity. A board member can't transfer assets to themselves personally, no matter what they're going to do with them. They just can't put them in their own name. So, so that's where I think you're at with that. And, I could see where, an accounting firm might miss some of that, especially in these, and it kind of gets me, but, and we're in the same boat to some degree because it's our competition. There are CPAs out there that are just turning out these audits, right? And they do take advantage of all of the shortcuts that they can. And so sometimes if the board doesn't disclose it, or the bookkeeper doesn't disclose it, they might not find it. And if it's material, they should find it. So, and to me, probably anything done in the investment area is going to be material. But so that's where it's at. I think it's a big, it's an issue. And if that's a problem for your association, I would notify the CPA firm. There's nothing that would prohibit you from doing that as a unit owner. You doesn't even have to do it as a board member. Just as a unit owner, you get a set of financial statements. You ask the board, and they tell you that's what it is. There's an annuity there, and you see that it's not reported. I would call the CPA firm and ask for the partner in charge of that engagement and tell them what your question is and your situation is, and ask them if that's something that would affect the financials, and then see how fast they backpedal. So, but anyway, so, but I mean, it is a situation, and it could happen to any of us, I guess. But especially if it's something that's been a CD for a long period of time, and then the same amount was rolled into an annuity, and they're, maybe nobody noticed it per se.
It wasn't. It was initially. It was never a CD. It was listed. The auditor thought it was a CD all along, because that's what he was told.
Yeah. See, so I would think he would, and he would do, just because there's no way that he's got any kind of level 3 disclosure in there probably on a CD. I mean, and if they do, it's not the right disclosure. So they've got a financial statement out there that's materially misstated, and at least from and a lot of times people think material misstated means that the numbers are wrong, but that doesn't necessarily mean. You can have a financial statement that has a material misstatement because the footnotes are wrong, because the disclosures are wrong, even if the financials were right, which in this case they probably aren't. But I'm just saying that, I would think the CPA would want to know that and would want to make changes.
Yeah, well, what happened was that yours truly brought it up and really caught it for bringing it up. And the CPA just had a shocked look on his face. And when it was confirmed, and my point was that for the sake of transparency, it needs to be listed as an annuity, because that's what it was.
Right.
And so the revision came out that simply showed the Note 4 fair value measurement and the annuity contract included in cash, all right, was now listed under level 3. But that the amount in cash never changed.
Well, that shouldn't be the case. It's not cash. It's an annuity. So it needs to be in a separate place on the balance sheet, because it affects liquidity. And that's what the person's not looking at. But you can't just go get that. You can't just cancel that annuity without penalty. So therefore, it's a misreporting, and it affects the liquidity. And that's a factor in any financial statement, is how fast can you get to your assets. And a balance sheet is listed. A lot of people don't look at balance sheets, but a balance sheet is listed. And the way that a balance sheet works, particularly a classified balance sheet, which not all condos use, but in general, on a balance sheet, the most liquid assets go first. So it's cash. Then it's typically, if you had CDs, they might be included in cash, or they might be included in other current assets. If you had inventory, that's listed early on, and those kind of things. And then things like fixed assets and long-term investments and things like the bonds and things like that you might own, they go further down because they're not as liquid. So that they shouldn't be in cash. And again, if I'm looking at my reserve balance, and I see my reserve balance is 600,000, and then I look in cash and I see that there's 600,000 in cash, I'm going to, as a reader of the financials, I'm going to be okay. If we have something happen, I've got 600,000 put aside, and I got 600,000 in cash, and I can get to it real quick without having to borrow money or anything significant. So I'm okay with that. But if it turns out, on the other hand, that I got 600 in reserves, and 300 of the 600 is an annuity that I can't tap without a significant penalty, or I might not be able to tap at all, that means I have to borrow money to fund my reserves again, because I've already funded them once. That I may have to borrow them until I can get that money out, and that's a problem. So, and that should be disclosed. It's a material, it's a material effect on the reader in terms of liquidity. So that's what I would look at as a CPA.
The broker, when he gave his little dog and pony show, informed us that regarding our investments, if we need money right away, everything can be collateralized.
Yeah. That means you can borrow against it. Yeah. Oh, good.
Everything's
Everything's collateralized. I got news for
Yeah.
you. You guys can borrow money probably just as cheaply from the bank, but that doesn't mean that it's not a problem. So,
Right.
yeah.
Right. And then my other question would be, if somebody actually brain lights up and they say, geez, these investments, this is totally improper and we need to gradually liquidate this between any capital gains, which would be taxed at what, 30% for us?
There's no capital gains on this transaction. You're going to have ordinary income, and it's going to be taxed at ordinary income tax rates, which right now is 21. The question becomes: this transaction is a tax transaction that is subject to tax. So you are going to pay tax on it, and if you're doing a 1128, you're going to actually pay at 30%. So
right,
which
is what I think we would wind up doing.
Probably. So because most likely you've commingled and stuff on your reserves, so you don't have the ability because of this very transaction. You don't have the ability to be able to probably file an 1120, which would make your tax rate a maximum of 21%. So you would be looking at a 30% tax rate on it.
Yeah.
Yeah.
Okay. Come on, rain.
Yeah. True. Floated away. But that's good, Barbara. And Barbara, I mean, you did a good job for your association. Whether or not, even if they didn't do anything wrong, and it's still something that the people in the community need to understand, because not everybody is going to be comfortable with that kind of risk. Even if it was legitimate, they're not going to be comfortable with that kind of risk. And it's important for them to know that risk exists for the money that they think they've put aside for their roof. And they don't want, or whatever their repair is. And so it's one thing if the members know it, if they've got the financial statements, they can make their own decision at that point. They can then, go to the board, they can elect a new board, they can file a complaint with the state, they can do whatever. So sunshine in this case is a good thing. And you did a good job for your association to bring this to the attention of the CPA, and they have to deal with it as well. And they need to look at it and say, do I need to do something different here? And the fact that they're not getting paid for it is not an answer. So,
yeah.
But anyway.
Yeah. And unfortunately, with the age structure in this community, honestly, a lot of the people don't understand what's going on.
Yeah. No, this is a technical issue. I mean, it is a technical issue. It's an important issue, but it's technical. And it's one of the things that accountants, have a hard time with, because most of the associations, including their board, including their bookkeeper, don't really understand how to account for this, even though they're supposed to. So yeah, it's a difficult, difficult issue. Yep. So.
All right. Yeah. And then of course we also, you have the issue at our age group, if one of the annuitants dies, and what the possible ramifications of that are, and whether or not the money gets tied up because other people make claims. I mean, it just gets complex. I just don't understand how a number of board members were convinced that this was an appropriate move, if in fact some of them were even informed of it. I just don't think that they had the background to understand the risk involved.
You're right. And it's again a case of an association trying to of the board trying to be a hero, and we can make this big money, so we don't have to ask you to contribute. And these are the kind of things, isn't it hell that's paved with good intentions?
Yeah.
But it's kind of the same thing here. It's one of those kind of things where probably this is just an ego thing. So board members wanting to say, look, we can do better. We can get more money for you. We don't need to, your assessments won't go up. We'll keep your assessments down. And, they'll forget that they could lose your principal or a large portion of your principal. And it wouldn't take much at all. A half a point, 1 point interest rate increase could wipe out your a significant portion of your principal, 10 to 15% of your principal. So, it's, or you could be forced holding that annuity until its maturity, which could be, way down the road. So anyway, yeah, it's just a case of some people just thinking of it as their money instead of thinking of it as the association's money is what they're doing.
Okay.
All right.
All right. Thank you very much, gentlemen. I really, really appreciate your answering my questions.
No problem. Thanks, Barbara. Talk to you later. All right. So, so it's kind of an interesting situation. Peter, I got to answer an accounting question. I thought that this was like the first time in like 14 years, right? I mean, I got to do an accounting question. So it's kind of funny.
Very exciting. I was on the edge of my seat.
I know you were. So I know that's the tough thing about being an accountant is that being a CPA is that the stuff does actually make a difference, but most of the stuff is either so boring or so technical that nobody cares, and I
was just teasing you.
No, but I'm serious. And I give Barbara a lot of credit because a lot of people won't stay after a complicated issue like this. When they get an answer from the board, and the board probably doesn't know, so they were bluffing. When they get an answer like that, the common thing is to think, well, they know more. I'm being told by this person and this expert, so they know more. And so, you just kind of back off thinking, oh, this is something I just don't know. But it's, you got to stick with it. And I do think it's a good, it's great that, that we have an opportunity, or that people have an opportunity to talk to us, and particularly you most of the time, to be able to get some guidance on some of these things, and
no, it is important, and we've talked about this before, but I think there are a lot of associations out there, and I thank Barbara for calling, that have put their money, because again, I've said this before, I mean, I think that their intentions are well placed, but when they think they can make money and they can do better, and why get 1% when they can get much better return, and they do investments that just quite frankly either aren't permitted or just are too risky for an association context. Right. So and I don't think this is, I think this happens a lot. Especially we have board members who have been in business or maybe even in finance for their whole careers, and then get frustrated when the association's money is sitting in some, S&L or
right.
some CD, bringing next to nothing, and that's hard for them to deal with sometimes, I think.
Yeah. No, I know. And because they're used to dealing with individuals and individuals' money, and right. And I tell you, it's kind of funny on a related issue is that as you know, I was in the banking industry for a number of years, and pretty high up, and one of the things that I always thought I saw was the most frustrating thing for board members at banks is most of these board members were business people. They owned their own business, and they were
right.
successful, of course. That's why they were on a bank board, is that they were successful. Well, but they were successful because they were used to making decisions and taking action immediately and getting something resolved. They didn't fool around, wait forever, and okay, we'll do this, a couple of years from now. And the problem is that when you get into a bank, you can't make those kind of decisions because of the regulation and everything. And it was frustrating for board members because they couldn't understand. Well, I remember one of the banks I was with, we were sitting there, and one of the board members at a board meeting said, who was in the construction industry, said, I think we should have a branch in Jensen Beach. We had a branch. Our main office was in Stewart at the time. Said, I think we should have a branch in Jensen Beach. And, everybody said, yeah, that's where we're looking at. And he says, well, look, there's a good piece of property right here. Let's get this piece of property. We can have the building up in 90 to 120 days. Just say the word, it'll be done. And so they said, so the board's getting ready to vote to do that. And we had to point out to them that, well, first of all, you got to file an application. You've got to hire a consultant to show that that property is going to be successful as a branch. You've got to make sure you're meeting your community reinvestment. And so the board member looks at us and goes, well, then how long is this all going to take? And I said, well, if everything goes good, we can get it done in a year. And they're like, do what? You guys are out of your mind. And that's why ultimately the board made the decision to sell. There was a lot of responsibility, nothing that you could do quickly. And so they got frustrated by it because it was way different than the real world, And so it's the same thing with a lot of this. Just like you're saying, the board members get frustrated because they want to take action and they're okay with that risk. They feel like they can deal with it. But it's when we look at, it's the same situation when we look at not providing reserves. This is one of the things that I get irritated about. Here's a situation where they've provided reserves, but they're putting them at risk potentially and could lose some or all of them. And the assumption that they make, for example, is in this case is that, well, if we lose 10%, but we make 5% per year for a few years, we'll make it up, So if we lose the money, it's no big deal. Well, first of all, there's no guarantee that the next board's going to continue the strategy. So it may be you're not going to make an additional 2% for the next 10 years because you may need the money, or they're not going to follow, or they're not going to continue the strategy. But also it's a case that when you do those kind of things, you're thinking, okay, well, I can afford a 10% loss. But you know what? Your neighbor who's over 55 and on a fixed income and has Social Security only, they can't afford. They already took some of their money and put it aside so that they wouldn't have to borrow money or do something later. And you'll get the board will say, well, if we have to, we'll borrow the money ourselves. Well, you're not borrowing the money yourself. The association's borrowing the money, and the unit owner's got to pay the debt back. So they're still borrowing the money, and that's money they don't have. And like I said, it's the same thing with not providing reserves. I hate it when, people don't provide reserves thinking that, well, we'll just special assess. Well, unless you know the financial situation of every single person in your community in detail, you don't know whether that person's going to be able to pay a special assessment. And I don't care what community you live in. We find out that people who are billionaires really may not have billions of dollars in cash readily available, right? And so, so it's a crazy thing. So I just get, I do appreciate, and like I said, appreciate Barbara bringing that up and getting on top of that issue so that her unit owners can know. And if they're willing as a community to take those kind of risks, as long as it's legal, then I think they can take them. But at least you should know that that's what you're doing. And I guarantee you there's some people on fixed incomes in that community somewhere who are saying, no, I can't afford that. And I don't want to cash in my IRA, pay a lot of taxes and not have my money for retirement, So anyway, so it's kind of interesting what's going on there. And it does, like I said, it does affect the tax. It does affect the tax situation a little bit too, which could result in a bigger problem for the association, particularly if they had to file an 1120 instead of 1120H. They may put themselves at risk for significant taxes. So anyway, so it's an interesting and good topic on this thing. Other than I think one of the things, Peter, I wanted to talk about, unless we get another call here, 220-9788, 220-WSTU. We have about 4 minutes left. Just as we talked a little bit, Peter, about the whole thing with common property and material alterations and all that. We talked about that last week, I think, and have talked about it in the past. I have a couple situations on the property management side where pieces of property that were undeveloped by the original developer were basically turned over to the association when the developer got out of the project. The developer decided not to build the last phase or couple phases of those things. Um, and the best I can tell that the documents still are accurate, are still active, and allow for that to be built. In one case, the association owns the property, I think, and in the other case, the property is owned by an individual, but it's covered by the association's documents. And I know you don't do a lot of that type of work, but are you seeing some of this? At least up here in Martin County, with where property values are, I'm seeing people digging for old pieces of property that can be developed quickly. And in the one case, the zoning on this parcel is actually not the condo. It's zoned. It was supposed to be another phase, and it was actually going to have some, I think, townhouses or single family homes. And the developer wants to come in and basically build them, have them be part of the association, especially since where they're located, they'd have to have ingress and egress, and is going to wanted to build a rental project in there. What's your, and again, I didn't leave you a lot of time, so just if, we can talk about it next week, but what's your thoughts on that, Peter? Have you seen some of those coming through, and what are your thoughts on that type of situation? What should the associations look at?
Well, I haven't personally seen it. It's somewhat unusual, and we don't have a lot of time here, but there's a lot of factors that go on to something like that. I mean, is the property owned by the association? If it's owned by the association, then unless their declaration provides otherwise, in order to sell that property or to lease it, it would need 75% of all the voting interests in the association. To alter it or improve it, same thing, unless the declaration provides otherwise, 75% approval. So there's a lot of different things that would go into something like that. It's hard to, I can't say that I've seen it. That's not a typical scenario where an association owns undeveloped property. So I'm not sure what you're saying, would the association sell it to a developer?
I think in one of the cases, a subsequent developer already owns it, but anyway, so we can get into it. I think maybe a little bit next week and kind of just discuss it. But anyway, I want to thank everybody for joining us. Thanks for joining us here. Join us again next Monday from 9 to 10 o'clock right here on WSTU Digital 1450. We're Martin County's Heritage Station.